Welcome to Street Check, the weekly podcast from Cabot Wealth Network, which has been publishing investing research, insights, and recommendations since 1970. I'm Chris Preston. I'm Vice President of Content here at Cabot Wealth Network and Chief Analyst of our Cabot Stock of the Week.
And I'm Brad Simmerman. I'm our web editor and the Chief Analyst of the Cabot Wealth Daily. This week, as always, Chris will be defending his hottest take. We will be touching base on three major news items this week, how they're impacting the market. And then we're going to do a new segment we're calling Jump Ball head to head. We're going to compare two potential performances for the rest of the year against a variety of sort of oppositional outcomes. So sort of a head to head game, if you will. But before we get into all that, Chris, I am curious, what are your summer travel plans, my friend?
Well, you will be doing this solo the first Friday in July. This is breaking news. I'm going to family vacation to undisclosed location. So I think, yeah, that'll be the one if you're up for that. No big plans. Today's the last day of school for my kids, so we're just like, focused on that, and then we're sort of going to get to summer stuff, once it starts in about an hour and a half. What about you?
No major plans. We're still sort of we just got passports for the kids. Theirs had expired in March, and we're trying to maybe make our way overseas, maybe head to Japan this year, but that would be in the fall. So unfortunately, our summer plans are in flux. I do have to say, though, undisclosed location is a great way to invite conversation around your summer travel plans. It's like, oh yeah, I have plans, just don't ask me about them.
Fisher's Island, New York. The reason I didn't say it is because most people probably don't know where that is.
You could have just said New York. You could have just said New
York. You take a ferry from Connecticut, so it's sort of like it's in Connecticut, but it's technically part of New York, so you can see Long Island from it. Anyway, my family's been going there for years. So,
well, I hope it's a blast. I guess maybe have Jacob on. I don't know. We'll figure something out.
Yeah, if you want a combative one, that would be ideal. Yeah.
Oof. But let's get into it. This week, let's start off with your defend the take. Bold, maybe a little bit counterintuitive. No recession. You have 90 seconds. Clock starts now.
Yeah, there will be no recession, at least not in the next year. Right now, the odds are at 70% in the next year. Let's see, that's according to U.S. recession probabilities, Estrella and Michigan. I'm just not buying it. I bet they were probably close to that 6 months ago, or maybe even a year ago, that there was going to be a recession this year. But every time the data keeps coming in higher or better than the Fed or economists expect. There's a reason the Fed is still hinting at 2 more rate hikes, because what they've done is not really curtailed the economy much at all. May and April jobs numbers came in far ahead of expectations. Retail sales just came in at 0.3%, plus 0.3% for the month versus minus 0.2% estimated, and up 1.6% year over year. Manufacturing surprised rebound in orders and shipments this month. Federal Reserve Bank of New York's General Business Conditions Index expanded the most it has in 3 years to 6.6. We're in a bull market now, which psychologically helps things. We keep hearing there's going to be a recession, and I think the rumors of a recession are greatly exaggerated. I don't see it happening the next year.
All right, good. Hit the post on that one.
There you go.
Yeah, good timing. So, it is an interesting sort of conversation, because the traditional measure that everybody uses is 2 quarters of declining GDP.
Yeah.
We had that last year,
yes,
but that's not the technical definition of recession. That comes from an accountability board.
Yeah, men in a room sipping brandy says recession.
Yeah, exactly. A lot of opacity there. So it's, I don't know, maybe a spend session, right? Where like the American consumer, the spending habits and all the excess cash built up during the pandemic, maybe that's what's sort of weathered us through what would otherwise have actually been a recession. We've talked a lot about the strength of the consumer. But one thing you brought up there is the Fed. So when the Fed speaks, the market listens, and that means we have to continue talking about it.
Yes, yeah, it's number one in our big three news items for this week. Yeah, Fed spoke this week, so of course that's number one. They paused, no interest rate hike for the first time in 15 months. Inflation, there is definitely a response to inflation being down to an even 4%, 4.1% was expected. So now it's less than half of what it was this time last year. But the big caveat was that the Fed hinted at possibly 2 more rate hikes the rest of the year. The big difference is while stocks pulled back for about an hour and a half, they ended up being flat to up for the day and have continued on their merry way since. So is the Fed no longer the market boogeyman, regardless of how many rate hikes they do this year?
Yeah, I think that's maybe we've moved on.
Maybe not regardless, but if they did
like if the Fed came out,
people, but
if the Fed came out and spiked rates by 3%, 3%, it would terrify markets.
right.
But market participants have moved on. I mean, maybe I'm discounting the Fed a little bit, but they only matter as long as the opinion about what they do matters. And if the market's ready to move on, we're coming off an 18-month bull market or an 18-month bear market. The market's ready to move on. Rates are near the terminal level. Maybe they're 0.5% off in one direction or another. They'll probably stay here until inflation gets back below 2%. But it rapidly is approaching that level. We're seeing declines in the manufacturing indexes. We're seeing declines in the consumer price indexes. It's coming down. It seems like, Powell has been for 18 months saying, hey, we're going to look at the data. We're going to look at the data. And we're just seeing a continuation of that. So if the rates go up by another 0.5% this year, I don't think it's a surprise. I think that's the thing. It has stopped being a surprise.
Yeah. And these tiny fractions used to terrify people when it was a bear market. 25 basis points, when people knew a 25 basis point rate hike was coming, and then it actually came, what if Jerome Powell said something even slightly hawkish during that announcement, stocks would tumble 2% or keep going down for days. Now it's the reverse. These percentages aren't concerning people. Like you said, 0.5% is not spooking people. And the difference is, I think, is that it's flipped from bear to bull market. Last week we sat here and said it had just technically gone to bull market, but it felt very thin. Now, a week later, it's suddenly feeling like a real bull market with much more participation. And I think that's totally changed investors' confidence, outlook, and that includes the Fed.
Yeah, there isn't. So Andy Crowder, our Cabot Options Institute chief analyst, shared this with me yesterday. It's the smart money versus dumb money confidence. Right now, dumb money 0.81. It's super bullish. Smart money 0.24, super bearish. So I think the sort of other edge of this sword is it not that the market is ignoring the Fed from an institutional standpoint, but just from a retail standpoint, and what we're experiencing is maybe a retail bull market. I think there's maybe something there where who do rates impact the most? Well, they don't really impact consumers a ton. Your credit card might swing a little bit. Your refinancing a mortgage gets more expensive, but the big impact of rates on the marketplace is the institutional lending cost or the institutional borrowing cost. And if they're still not super active market participants, I wonder if maybe they're being less responsive to potential Fed moves. So I think there is an aspect to this that might be limited to sort of a retail rally over versus the actual economic impact of the Fed. Just a sort of consideration there.
Yeah.
And that actually leads me to our second of the big three, which is what the market does when everybody knows something is coming. And what I mean specifically is health insurers. Humana came out on Wednesday and said, hey, we're going to take an earnings hit because everybody who's been delaying healthcare for the last 2 years is finally getting those procedures, and we need to pay for them.
Right.
On the day they announced that, they dropped 11%, United Healthcare down 7%, in the last 5 days down 9% and 5% respectively. And the thing that prompted this is you and I have been reading for 18 months that these biotech companies, these med tech companies, they're not missing earnings, they're deferring earnings until people are ready to go back into hospitals, once the pandemic phase has sort of fully passed. So we all knew this was coming, but the market didn't price it into the insurers.
Mm-hmm.
And it's a strange dichotomy to me that something that everybody's been talking about for 18 months, there's this one aspect that just seems to come out of nowhere. And I think it's probably a useful thought exercise or general exercise is to consider second order effects when you're investing. So if I'm investing in a health insurer because they're going to generate revenues, whatever happens, people need health insurance. You don't want to go to the hospital without it. They're very stable and reliable. But then at the same time, people are deferring procedures. Well, that's going to catch up to them eventually. And we should really price that in and start considering some of the second order effects when considering an investment.
Yeah, and actually, Tyler London, who runs our Cabot Small Cap Confidential Advisory and Cabot Early Opportunities, he wrote in his update the other day about this, and he said, he thinks, well, this is negative for, as you mentioned, health insurance, health insurers, and managed care organizations. Is the way he put it, for, like UNH. Higher procedure volumes will actually be good for hospital and medtech stocks, of which he has several in both of his advisories. If people are looking for medtech stock ideas, do you agree with that?
Yeah, absolutely.
Yeah.
So EHC and HCA, I don't remember what the acronyms are. They're two ticker symbols there for some of the larger hospital groups in the U.S. Both up 2% on the same day that Humana announced that, hey, we're actually going to have to spend this money. And then as of yesterday, EHC up 2%, HCA up 5%. So we should have seen it coming, and hopefully, if you're an investor, you did. But it's sort of strange to encounter these second order effects that should be very obvious in the moment, but that the market just sort of misses.
Yeah. Well, that's a good transition to our number 3 and our big 3 things that you could see coming down the pipeline. The writer's strike in Hollywood is now on a month and a half in. May 2nd is when it started. No real end in sight. It sounds like the DGA, Directors Guild of America, is joining the fray. And how will that, if it drags on a while? So just for context, the last one of these was in 2007, 2008, lasted 100 days, so a little over 3 months. But that was in a very different time. Netflix was mailing DVDs. At that point, there were no streamers. There's no streaming. Now there's all these streamers, all of which are public. At least there's companies. Netflix is a pure streamer, but there's companies that have streaming is a big part of their business plan, how they make money and how people invest, why people invest in them. How long will this thing drag on? Does this thing need to drag on for it to show up, and when will it show up in their bottom lines? I.e., if there are no writers, the longer there are no writers, the longer we go without any new shows being written, and there could be a big gap, a la 2020.
Yeah.
When will it show up and start to hurt them, and who is it? What streamer is it worse for?
So like you said, second order effects, right? We all know the writer strike is happening. SAG-AFTRA voted to authorize a strike as well, so that union could join the fray. The Directors Guild of America has penned their own deal with the studios. Up until a month ago, what I had heard from people covering the writers' strike specifically was typically what happens: the writers' strike, it's meaningless. SAG strikes, and it puts a little bit more pressure on studios. And then the directors come in, and whatever terms they strike sort of become a framework for the others and can accelerate the strike process. It doesn't sound like it's happening this time. And, like you said, 2007 was the last time we had a prolonged writer's strike. It was, I believe you said 100 days to me privately before we started the record. And we're approaching that number already. So
we're halfway there. We're about halfway there
yeah.
right now. But yeah.
So this thing
if it exceeds 100 days, would not be a surprise. It doesn't seem. Yeah.
Yeah, I agree. So who does it impact? All right, let's look at the big streamers. Netflix, you've got Apple TV, you've got Amazon Prime, Warner Brothers Discovery, and then
Disney,
which
has Hulu and Disney Plus
and ESPN.
Yeah, you're right.
So Amazon, we all just have Prime, right? We just take deliveries. It doesn't seem like, and even if people are subscribing to Prime for the Prime TV product, that's still an insignificant source of Amazon's revenue. Most of their revenue is Amazon Web Services and order fulfillment. So they're fine if they take a little bit of a haircut.
Same with Apple.
Yeah, same with Apple. They produce some great content, but you're buying iPhones. That's their big profit.
And they're so early. I feel like they've been the slowest of the major streamers to really get their. They don't have the deepest library, I wouldn't say, in their content streaming. So they're not even compared to like Prime, Amazon Prime. So if all their shows go away, that's like 5 shows.
Yeah, exactly. But the Netflix is one that will obviously be harmed because they're a pure content play. Warner Brothers Discovery derived 80% of their revenue in the last quarter from what they call direct to consumer. So that's subscribers and that's content, including games assets, things like that. Disney, by that same sort of metric, 2/3 of their revenue came from direct to consumer and content. But their revenue numbers are double Warner Brothers Discovery's. The Disney parks was almost $8 billion in revenue last quarter alone, compared to $1 billion for Warner Brothers Discovery. So that park is an insulation. And
Disney had, well, you mentioned ESPN Plus and just ESPN in general. They have live sports. It's not going away. That's not affected by by anything the writers do.
Yeah, and the other question is sort of the content library thing. So if you're a studio, if you're, for our purposes, Netflix, Warner Brothers, or Disney, how do you demonstrate like an abundance of new content when you can't actually make anything new?
Yeah.
Disney, you could potentially unvault something if they've got shows that have been produced and then were not well received and taken off the air. Warner Brothers Discovery can do that to a same degree, but Disney also has licensing, has iconic characters that it can license out in a way that Warner Brothers and Discovery can't. I mean, they have the Harry Potter assets, which is a cash cow for them, but it's not. I mean, if you want to throw Mickey Mouse in a new play set or whatever, it's like that could be $1 billion decision for them. The big wild card for me is Netflix. Because of their international content, they're less leveraged to the US production system.
Yeah.
I would guess that Netflix weathers this storm better than Warner Brothers, even though Warner Brothers has the park assets and the Harry Potter assets. I would bet that Netflix navigates it a little bit better because it's got this deep pool of international content. Squid Game showed us that Korean language programming can work for a global audience. Find the next Squid Game. All you have to do is pay a translator and pay somebody to type captions on it. Right. So you can stretch your content library a little bit more there.
Yeah. And Netflix, it seems counterintuitive that they're the only real pure play streamer. But they have, you mentioned the international aspect is a buffer, but they're just also such a geyser of content. There's so much there. They are definitely a quantity over quality. They have some hits, obviously, but there's so much there that it almost, I think that has at this point is working against them. And I think if you slashed the number of shows they have in half, A, would anyone even notice? And B, I don't know that it would hurt them all that much in terms of subscriptions. But Warner Brothers Discovery, they own HBO Max. I guess it's just Max now. HBO is totally a quality over quantity. They don't have many shows, but the ones they have are always in the consciousness, and that their names. Succession just finished. Barry, Game of Thrones, the Game of Thrones spinoff, that was the House of the Dragon. Last of Us did huge ratings. Euphoria. If those go away, people are really going to start cutting. We talked about cutting the cord with TV. People will be cutting the cord on Max if those go away for an extended amount of time. So I think they are the most prone, and they don't have the Disney buffer of live sports.
Yeah, and the Netflix, the content geyser that you're talking about, you can repurpose that content geyser. You could re-release 12 new Netflix shows over the course of the next year, or release them as new and just market them a little bit differently.
Right.
And 80% of the people will not know that it's not a new show.
Right.
My wife was watching Snack versus Chef or something like that. And it's
never heard of it.
It's a cooking reality show where they try and recreate like convenience store snacks. It's kind of interesting. It's not a bad show, but I don't know if that's a year old or 10 years old. They could release it tomorrow and say it's brand new, and most people are not going to have any idea. So I think that actually is a little bit of a raft for them if this writer strike drags on.
Yeah. Well, something to keep an eye on. This may show up. This will probably show up in earnings towards the end of the year, especially if this really drags on. But something to monitor at least. Okay, let's move on to our featured segment today. No guest today. We're doing a featured segment we're calling Jump Ball to keep with our vaguely basketball related theme in this podcast. So the concept here, Jump Ball, is there are two things that we are pitting against one another, and we haven't played this out, so we don't know who's taking what side, whether we're taking both the same side in some cases or different sides. We're going to pick what we think will outperform the other for the rest of the year. Most of these are just for the rest of the year. And we'll each do about 30 seconds. Let's do 30 seconds each to keep these going. I'll start with number one. What will outperform the rest of the year? The Dow or the NASDAQ?
I'm going to jump for the Dow. NASDAQ did a remarkable job of dragging us out of the bear market. We've written and talked about the fact that it's the mega cap tech stocks that have pulled us higher. Now it's on the market to catch up. And for my purposes, that makes me a little bit more bullish on the Dow over the NASDAQ.
I'm going to go NASDAQ. Tim Lutz, who used to run Cabot, retired last year, like saying trends last longer than anyone ever thinks they are, and thinks they will. And I think that's true. The NASDAQ rally, everyone's like, oh, it's so overbought now. And that's probably true on a technical basis. But, now we're in a bull market, and people don't tend to start selling, especially tech stocks, in a bull market. Dow stocks are usually, the types of stocks that are good safety plays in down markets, although that hasn't been the case the first few months of this year or even late last year. I think NASDAQ will continue. I'm not saying there won't be pullbacks, maybe even a hard comeuppance, late in the year, but I still think NASDAQ will outperform.
Yeah, as a little bit of a button on that, yesterday in my conversation with Andy Crowder, he mentioned that he was seeing overbought RSI's relative strength index in a lot of these big leaders. And one thing that I told him, which is sort of aligned with what Tim says, right? overbought conditions technically remain overbought in a bull market. So excuse me. So there you can remain, even though it looks like a bear signal when this RSI is massively overbought, it stays there in a bull market because that's what's moving the market forward, is the flood of investment.
Yeah.
Let's piggyback on that a little bit with the NASDAQ versus Dow. AI stocks versus any other subsector.
I guess I'd be contradicting myself if I said any other subsector, because AI stocks have led us to this bull market. And while they've slowed, and we talked about, there being a pause, AI is real. It's here. And while there may be a pause, maybe there'll be a summer pause, I think AI is here to stay. AI stocks are going to continue to run. And I think if I'm saying that the NASDAQ's going to lead the way, I think AI is going to be a big part of that. So I say AI stocks will be the best performing sector from here to the end of the year.
Yeah, as of yesterday, NVIDIA was up 198% year to date.
It was 184 when I wrote about it 2 days ago.
Yeah, and it was 173 when Bruce wrote about it a week ago.
Yeah.
I am treating this as AI stocks versus the field. The
Right.
field bet, if you're wagering, is, hey, either this guy scores the most points or anybody else beats him.
It was
I'll
like
go with
Tiger versus the field back in his
exactly.
heyday on the PGA. Yeah.
Yeah, it was, can anybody beat Tiger Woods? This is, can anybody beat AI? Yeah, I'll go with MedTech, right? Like,
Okay.
I'm not making a specific pick. I'm picking the field, but if I have to make maybe a compelling case for it, I'll take MedTech. The insurers said they're spending. MedTechs have been oversold for a long time, right? We saw the bear market in biotech and small caps. I think those have probably the most room to run. And if I had to pick one subsector to beat AI, that's where I would go. And maybe partially because the AI hype cycle has a spot in MedTech, which is, AI discovering a new chemical compound or a new drug or whatever, but it hasn't been expressed there. So the AI hype cycle, I could see pivoting to MedTech and actually giving that subsector some juice too.
Right. Yeah. AI itself, pure AI. I guess the next leg of that rally could be spreading to other sectors like MedTech. So it's almost like, it's splitting like hairs a little bit, but yeah. Yeah.
Well, it's something we had talked about before. It's like, okay, well, we need to see this sort of all this major revolutionary AI start hitting bottom lines. There was an informal survey, something like 20% of the population had used the Chat GPT tools, and we talked about how popular it had become, but it became really, really popular, and then is just sort of at an equilibrium point now. And we need to see the results at the bottom line. And I think MedTech is a place that makes a lot of sense.
Yeah. All right. Let's go to the next jump ball. Sticking with tech stocks, the two top electric vehicle makers in the world, Tesla versus BYD. This is a Chinese company, symbol BYDDY. That's the the ADR that it trades under, which both have tons of momentum. Tesla's more rebound momentum. BYD, its revenues tripled last year. Which do you think will be the better performing stock from here to the end of the year?
I'm going to piggyback on what I was saying about the sort of overbought conditions that we've got here. BYD up 34% year to date. Tesla up 137% year to date. BYD has room for growth. 6 months ago, we were talking about whether that Tesla sell-off was a re-rate where the company started treating it, or where the company was being perceived more like a major car company. And, I think Tesla's got room to expand the picks and shovel aspect with the supercharger stations, but BYD already out exporting them, already out producing them. Give me BYD.
I agree with you here. I like both stocks. I may have exposure to both in a certain newsletter that I run, but BYD is, for how much it's growing, like I said, tripled revenues last year. It's been 90% plus growth. It was in the first quarter of this year, and I believe in the last reported month which I think was May. Same thing. Its stock is not where its fundamentals suggest it should be. I think a lot of that is, China's being slow to the draw and reopening, reluctance to buy Chinese stocks, period. Like you said, only up, what was it? You said up 18% year to date, something like that.
34%.
Oh, sorry, 34, but Tesla was, triple that or more than triple that.
Yep.
I think I like BYD, and it's trading below its July 2022 highs, below its highs from a year ago. It was at 82 a share last July. It's now at 68. I love BYD here.
Yeah, I think the Chinese sort of the hesitancy to get involved in a Chinese company when they're going through tumultuous periods that could translate to delisting, maybe bans of sale, but something like a microchip manufacturing process, or something that's a highly valuable technical bit of knowledge, is a lot different than shipping an inexpensively made car with a battery in it, right? That's what China does best. There's a reason that every product on Amazon is flooded with a lot of Chinese manufactured products that are being delivered from overseas, is because they can implement at a very low cost pretty effectively things that are not at the bleeding edge of technology. So I'm totally with you. Give me BYD all day on this. The next subject for us, in honor of prior guest Matthew Tuttle, Cramer short fund versus Cramer long fund for the rest of the year. What do you think?
Jim Cramer.
Yes.
I'll go Cramer long fund. No, explain the premise of these two just quickly. I mean, it's so arbitrary, but yeah.
So the idea is that Jim Cramer became a counter indicator during the great financial crisis. He would come out and he would loudly proclaim, Bear Stearns is safe, Lehman Brothers is great, buy, and then he would be very wrong. Yeah. So much so that there have been academic studies of the performance of his stock picks. He's just highly visible. He has to make picks constantly. That's the nature of what he does. He actually outperforms better than random in a positive buy recommendation than he does in a negative sell recommendation. My case for going long Jim Cramer over short is it's a bull market.
Exactly.
What's he going to do? He's going to scream buy Nvidia, and then it's going to go up another 30% over the rest of the year, and that's going to be that. And you can be a bad stock picker in a bull market, or you can be an average stock picker in a bull market and still make a lot of money. In a bear market, that's where you need the expertise.
I think that the SGIM, the short Jim fund, when we talked to Matthew Tuttle, a couple months ago or a month and a half ago, I would have probably gone with that then, but now that we've gone bull market, I think LGIM is the play. Okay, next up, let's start rattling through these. Fed, we talked about this earlier. Fed 2 or more rate hikes the rest of the year, or 0 to 1 rate hikes.
So the most recent meeting, Fed members, they were anticipating rate hikes at the end of the year in the 5.6 to 5.8 range, which would imply like 1.5 rate hikes. Give me Fed 0 or 1. I think there's 1 rate hike in the rest of the year ahead of us, especially if inflation is continuing its downward path like it has been.
Wow, I did not see that coming. I thought we'd definitely be on opposite sides of the spectrum here, since you're the most hawkish Fed member. Generally, I say I've had 2 defend the takes that have said no more rate hikes the rest of the year. I can't go against that now, so I'm going to say 0, even though my take today is sort of predicated on the Fed saying that they may hike rates twice more this year. But I'm going to say 0. Inflation's at 4% now.
We were speculating. We were speculating over what percentage the inflation rate could be at before the Fed starts sort of maybe considering raising their target rate to like 2.5, or sort of finding an acceptable level. We were talking about 3.5%. We're at 4. It's sort of close enough for army work. All right. Sell in May. So May through October versus November, December performance for the remainder of the year. You had the hot take of sell in May would not work or would not be applicable this year, and
Yeah.
you have been demonstrably proven right. I mean, we're at 14 month highs on all the major indices. So
Yep. Yeah, let's
we're
see. It's up. We're up about 12-13% since the start of May right now. So that's a pretty good head start. I'm going to say sell in May period through October will be better than November, December. Even though November, December are traditionally two of the best months. And I'm not saying the rally is going to come to a screeching halt then, but just given the data that we have,
yeah.
and that we've now flipped the bull market, and those are hard trains to stop once they get started. I'm going to say the next through the end of October will be better than November, December.
Yeah, and I think the next catalyst that could result in some softness in the rally is probably next quarter earnings, right? Like the Fed isn't the driving narrative right now. Interest rates, inflation, not the driving narrative. Earnings will be. I think you can say, okay, well, earnings season when it hits sort of late August, September, October-y period, that's when, if there's weakness in the economy, it's going to trickle through. It could lead to maybe a softer performance numbers in November, December. I'm with you.
Okay. One last serious one before we get to a couple of fun ones. Bitcoin, this piggybacks on another defend the take I had a while ago. Bitcoin or oil prices, which will go higher the rest of the year?
Oil prices. I would have maybe been on the Bitcoin side with it being a risk on environment, but the feds are cracking down on crypto. Coinbase, the stock dropped 10%, facing charges from the SEC. Binance, the second largest exchange, being essentially accused of being a FTX junior. I think that it's going to be a hands-off asset class until regulatory and legal clarity come out of all this. I think crypto in general, Bitcoin, Ethereum, safest of them, but for me, that's a hands-off asset class right now. So I'd go oil.
Yeah, well, I got to stick with my take, Bitcoin, even though that was given before the whole Coinbase thing. Year to date, Bitcoin up 54%, oil prices down 8%. You would think law of averages, oil. I'm going to stick with Bitcoin just because of my premise on why I think it's going to rise higher. Is I don't really fundamentally believe in Bitcoin having any real utility right now, except for as a bull market play. We're now in a bull market. I think it'll continue for a while. That's why I think Bitcoin the rest of the year.
Yeah, the Black Swanny thing is if you start seeing a shutdown of access in the U.S. to any exchanges, like if Robinhood decides to no longer allow crypto investing at all. There was a recent announcement that a company had launched a new spot ETF fund. BlackRock had. So there could be a big institutional driver there. I'm not saying there are no positive catalysts, but just given the regulatory environment, I would take Bitcoin. I'm going to let you introduce these next couple. These were your pitches, so
yeah, these are my babies. These are non-stock related. If we end on a couple of fun notes, speaking of writer's strike, what will have a better box office the rest of the year of these two big summer franchise blockbusters involving very old superstar actors? Indiana Jones and the Dial of Destiny, June 30th release. Mission Impossible Ghost Protocol Part 1, Tom Cruise, July 10th. What'll have a better box office?
I haven't seen a Mission Impossible movie since the third one came out. That was probably 20 years ago. I will see Indiana Jones and the Dial of Destiny probably in theaters. I'll go Indiana Jones. I think there's just enough of a nostalgia factor where audiences are interested in going back to the movies. Maybe some people for whom, like my parents, they're not going to go see the Spider-Man Across the Spider-Verse. That was a great movie, but they're not going to go see it. They might go see Indiana Jones. I would go there.
My heart says Indiana Jones. but I think I'm going to go with Mission Impossible. That franchise seems unrelenting, and I know that there's a reason they keep churning these out. You know, they keep doing well. Tom Cruise, as we saw with Top Gun Maverick last year, is probably the biggest single box office draw among actors. And Harrison Ford, much as I love him, I don't think carries quite the same weight, other than maybe with, you mentioned your parents are going.
Yeah, I heard he got the Godfather treatment in Indiana Jones. I don't know, maybe that turns some people off, but I have no idea what the box office numbers look like for Mission Impossible.
I know.
It sort of lives in the same place as Fast and Furious movies in my brain. It's like I don't necessarily get the appeal. I know people watch them. I know they're popular, but I don't understand it.
Mission Impossible Rogue, what is it? Rogue something, 682 Rogue Nation, $682.7 million, 2015. Mission Impossible Fallout 2018, $791.7 million. Mission Impossible, there's Mission Impossible 2. So those are two of the recent ones that did incredibly well.
I'll flip my vote. There's no way Indiana Jones 5 is a $1 billion movie, but Mission Impossible 10 might be. One thing that I wanted to bring up when you had originally pitched the segment, I thought we were just going like, hey, what's this sort of interesting factoid? Which did better, this or this? So I was looking into it. I want you to take a guess. Who has done better? Both franchises, I'll call them franchises. Both the film and the franchise have each passed $1 billion. John Wick or the $1 billion plumber Super Mario? Which made more money, the entirety of the John Wick franchise or the single Super Mario movie with Chris Pratt in it?
Probably Super Mario.
1.315 billion as of Wednesday of this week. 1.02 for John Wick. One Mario movie has out-earned all 4 John Wick movies, and those are beloved. But
what studio made Mario?
It's Imagination, the same one that does the Minions and stuff like that. I don't know who owns them. Actually,
movie theater stocks, buy them. AMC, didn't we say AMC dead last year? Should we reconsider that?
No, so AMC is actually at risk of bankruptcy if they don't get if they don't figure out their ape stock and their meme stocks. Like they issued these ape shares as part of their meme stock run up, and if they don't reclassify those as common stock and then do a reverse split, they're at risk of bankruptcy. So I wouldn't touch them, but maybe whatever company is behind Imagination.
Yeah, I guess so. All right, last question, then we got to go. You live in, for people who don't know, you live in Arizona, Phoenix area, I believe. I live in Vermont, New England. I am a Red Sox fan, not necessarily a Boston sports fan across the board, but who wins a pro sports title first or next? Boston or Phoenix?
So a little peek behind the curtain. I was messaging you that I feel very Princess Bride. It's like, well, I have to pick Phoenix, but if I pick Phoenix, I have to pick Phoenix, so I have to pick Boston. But a smart man knows that I can't pick Boston if you're going to pick Phoenix. I got to go Boston. The D-backs are hot right now, but it's June. Most people don't even tune in till after the All-Star break. The Cardinals are a dumpster fire. They are probably getting the first pick. They go maybe 1-16 next year. The Suns flamed out spectacularly for the 3rd year in a row, which is not great. I'm going to go Boston. I like your chances better than mine.
I'm going to go Phoenix. I like the Durant Booker pairing. I think they're going to fill in. They just need to figure out a few pieces around them. I think they'll win one in the next go. I think they have a better chance than the Celtics. The Red Sox, no chance. Patriots, no. And I guess the Bruins would have been the one that they had blew it in such spectacular fashion this year. They might be scarred from that for years. Not that I've really followed hockey closely, but I know they had the best regular season record ever and lost in the first round. So I'm going to say Suns in the next 2 years will win one. Oh, I mean, fun fact or trivia. Can you name the one time that the two cities competed in a championship?
is it like Chicago Cardinals versus like Boston Braves or something in 1934?
No, cities. Boston Celtics versus Phoenix Suns, 1976. Celtics won in 6 games. JoJo White, I believe,
That's
MVP. You're familiar with his work.
a little bit before my
Dave
time. I probably
Cowens.
should have guessed that one.
Yeah, not in my
But
lifetime either. Okay, well, let's end on that note. Thanks everyone for listening. We'll be back next Friday. Again, please, if you listen on wherever you listen, please give a subscribe,
like, comment.
positive comment, 5-star rating, whatever. YouTube also, same thing. Helps us get the pod going. Any final words before we get out of here? Well, I think we're pretty over time.
Nope. Thanks for tuning in.
Yeah, see you next Friday.